Welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst, and this is my co-host,
Brian Leverage.
Brian, how are you today?
I'm doing well, Jeff. How about yourself?
I'm good. It's been a little bit since we've recorded a show where we weren't in the same room, but we're doing that today because we have a really special guest who is not in Tennessee, and so we had to do an online show today. Who do we have on the show today, Brian?
I think it's Terry Judge, if memory serves correct.
That sounds correct to me.
Yeah.
So we have Terry Judge from Core Solutions Group. He's out of Michigan, and he's been doing our cost segregation studies for the last 3 years. His company's amazing, and we're going to have him on to talk about the benefits of cost segregation studies and all of the other really cool things that Core does, and how you can get involved with Core and save money on your taxes.
So really jazzed to bring this one to everybody because it's personally benefited us substantially.
Oh, yeah, for sure.
Probably an understatement to say.
Yeah. No, listen, I went from having to pay taxes to not paying taxes. That's pretty awesome. I can't really argue about it. We'll get into that more right after this intro.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
Man, we're getting really professional here. It almost looks like we know what we're doing. Terry, welcome to the show.
Hey, we should all have our old fashioned drinks going on, man. It's like it's almost happy hour.
It really is. And normally we do drink old fashions. I'm drinking coffee right now in my Vulcan Heavy SpaceX mug. So that's what we're getting.
I ran out of glasses, so this is what I'm down to.
Well, I've drinking old fashions with Terry before, and he knows how to put them back. He knows how to smoke a cigar. We've had a good time a few different times.
For sure.
And I don't know, Brian, have you ever met Terry in person?
No, just virtually.
No. Well, I got to be honest, Terry, I'm super excited to have you on. Like I said in my intro, Brian and I have been using you for our cost segregation studies. Your company Core does those for the last 3 years now, and it has completely eliminated my federal income tax for 3 years in a row, which is amazing. I even have a carry forward loss going into 2020, so hopefully I won't pay taxes for another year. So what do you say about that? Is that normal in the real estate world, not paying taxes?
Well, if they're doing the other way around, they are paying taxes. If they're doing it the right way, which is the cost segregation way, they're not paying taxes. So there's the choice. I mean, that's the balance, and I think it comes down to education. There's just this massive gap in this community where people just they're not hearing this information, or they're finally just starting to hear about this information, and it's one of the reasons why I started the company 15 years ago, Jeff, because when I saw it, I realized oh my God, there's some massive gap. Only like the higher end players and the big four accounting firms were all over this concept, and very few people in the middle market and the lower end market, people buying their first, duplex or triplex or first multifamily property, they were missing out. And it was always like an afterthought. And that's how we started the company. And slowly but surely, it's really starting to catch on and go mainstream because people like you are spreading the word. And we appreciate you guys so much as, clients for the last 3 years. You've been referring business to us like crazy. So, thank you very much. It's so good to hear your story and how you have eliminated your taxes. I mean, and then it has a carry forward for 20 years. So what a planning tool, man. I mean, it is pretty amazing to see this, to hear the stories, to be involved in the stories, and to continue to educate. I'm just screaming from the rooftops.
And if you could give the audience a bit of a 10,000-foot view of what cost segregation actually is.
Yeah, Brian, it's got a funky name to it. I mean, I don't know who in the IRS came up with cost segregation. It sounds really bad. I mean, it really does. Maybe I've always tried to go with the word cost allocation studies, but cost segregation, for whatever reason, that name just kind of took hold. But essentially, there's two pathways in the tax code One is the straight line method. You're going to write your building off over a long period of time. Multifamily, 27.5 years. Other building classes, 39 years. And then in comes cost segregation, been in the tax code since the late 60s, believe it or not. It's another pathway in the tax code. It's gone through many transformations, many flavors, many enhancements, by the way, between Democratic and Republican parties. It has survived all this time, and it just keeps getting enhanced. But essentially, the IRS allows a building to be written off over a much faster period of time by breaking out segments or components of the building. It's like mechanical, plumbing, electrical, landscape, irrigation, non-load bearing walls. We get into all the interior build outs, and it's a big chunk of that purchase price. The wiring behind the walls and all the drop ceilings, and I can go on and on. There's hundreds of components in the building, but it makes up probably 30% of the purchase price that we now can write off over a much shorter period of time. Let's say 5 years versus 27.5 years, and you get to take that front-loaded depreciation schedule in the early life of that building. And I always say, why the heck would you? I don't know if I can swear on the old-fashioned show.
You can. You wouldn't even.
Why the hell? Why the hell would you? And that's my PG swear.
I thought you were going to swear.
Well, listen.
The end, Brian. I'm going to let it rip.
Hey, you know what? You're not going to be the first one, Terry. I mean, our friend Matt Faircloth dropped an F-bomb on the old-fashioned real estate show.
Okay, I'm right at the top, Matt, because he's a stud. Why would you let the IRS hold on to your freaking money for 27 years? I couldn't do it, dude. I'm a Christian boy. No, I'll do it. I just got to get fired up a little bit more. I don't think I've ever swore on a podcast. I don't know if I can do that.
Dude, you got this. In fact, I would even say you fucking got this.
Why would you let the IRS hold on to your money, your fucking money, for 27.5 years?
Good. Yeah.
When you can get it in your own pocket and use it to build your empire, like you guys have been doing.
Yeah.
And people say they think it's technical, they think it's aggressive, they think we're going to get audited, they don't understand it. And CPAs a lot of times, they're not promoting it because they're not involved in it, and they don't maybe understand. They understand it. I don't want to say that, but it's not something that that they sell or promote or do in-house in their own practice. So they would outsource it to a company like mine, and as you guys know, they do, and they think the value of it is massive. So that there's some myths about cost segregation that we always want to debunk about why to do it or not to do it. And there's some legitimacy because it doesn't work for everybody. Okay. Some people say, well, when do I not do it? And the only time you don't do is if you're going to flip the building. Let's say you're going to buy a building, you're going to flip it in a year. You're going to flip it in a year. I would not recommend having it done because there's something called recapture. The IRS is going to want that depreciation back. So it's not going to make much sense. Or the second reason you would not want to do a cost seg study is because the building is not profitable, or you have so much depreciation from other assets and it just you don't need any more losses. Or the building is sitting vacant and maybe there's no tenants in it yet because there's a big build out or renovation going on. You might want to wait till you get the date of occupancy, then we pull the trigger. Those are the two only reasons, guys, that you probably, in my opinion, in my experience, you would not do a cost seg study. If you're buying the building, you're buying it for profit. Go ahead, Jeff.
Right. So, I was going to ask. So if I go out and buy a $35,000 house in Inkster, should I be doing a cost seg on that?
No.
So the third thing is it's got to be.
If you have $135,000 houses, or even 50 or 10, anything that makes up what I always rule of thumb. If you got $500,000 in real estate, I don't care where it comes from. It can be from a bunch of small single family. It could be one small multifamily. $500,000 is really the sweet spot and up. It used to be $1 million. We wouldn't even really do a study if it wasn't over $1 million because economically It just didn't make sense. And then now with the new changes of the tax code, when we get into the CARES Act that kicked out, as you guys know, it's created a whole kind of a game changer, through the pandemic and all that stuff, where you can now, actually, this was before the pandemic, but if you buy a building from September 27th, 2017 forward, you qualify for bonus depreciation, which is now it's depreciation on steroids. It's just like bam. So now instead of waiting 5 years for your interior improvements to be written off, or your exterior, which was 15 years in the normal cost seg world, you now can compress that to 1 year in your very first year of ownership. You can take 100% depreciation, and it has a 20-year carry forward. So you're never going to lose the excess that you can't use in year one. But a lot of big investors love first year bonus depreciation. It's been obviously a big game changer. You can see why. More money today. Time value of money is really the definition of cost segregation. I'm like Italiano.
Yeah. Well, listen. So that's how I've eliminated my taxes, as you know, because you've done these studies for me. But
right.
But it's the bonus depreciation. I mean, I bought a building for around $1 million, and we got close to $200,000 in depreciation. And Brian and I bought a building this year for $700,000, and we got $150,000 in depreciation for this year. Right. So that's crazy. More than we put down on the building.
Right. You're actually literally getting your investment back in the form of write-offs. You can really write off your investment. It's very powerful.
Yeah, it's insane how great it can be. Now, listen, so if you want, why don't we talk a little bit about some of the other stuff you do? I mean, the cost segregation stuff is amazing, but tell us just a little bit more about CORE. And I'm also going to put up a website here. I want to full disclosure to everyone. We have partnered with CORE, Brian and I have, to help people get, high quality stuff. We're already referring people to CORE already. Now we're making it official. CORE and Terry, you guys are the official cost segregation company for old-fashioned real estate. We're going to, everyone who follows our show, even if you don't follow our show, you're just hearing this randomly, you should go to thecostsegguide.com/old-fashioned real estate home, and you can sign up and get more information about cost segregations. And learn more about CORE on that site as well. But what other stuff does CORE do, and how can people get involved in that, or what should they be looking at?
Yeah, so we started in cost segregation 15 years ago. So you can imagine there was only a handful of us back in the day. And so we really are pioneers, being involved all this time with the IRS, just the whole audit defense and things that we've added into our studies.
Can I stop you for 1 second there? You didn't actually even mention this before, but this is one of the things that sold Brian and I on you originally. 15 years, $1.5 billion in tax savings, and zero crazy IRS disallowances. So never anyone's been lost out on these cost seg studies from your company.
Yeah, we just finished up a cost seg study. I just looked at the numbers this morning. We saved this one particular company. They're a large company, couple large buildings that we did. $10 million.
$10 million.
$10 million. And I'll tell you more about this one particular company. They've been a great client, but we've done a lot of stuff for them. So just to get back to your question, what else does CORE do? So cost segregation, we've grown that practice nationwide. Got a lot of great clients like yourselves, and now partners. We'll talk more about kind of this partnering with our clients. But we do other areas. So we knew our clients have other needs, and because of our background of being engineers, CPAs, and legal, in order to, that's what we do. We have the three we understand construction. We understand, just all the components in the building and all the engineering analysis, but also all the accounting stuff that you have. And there's a ton of legal. There's over 300 IRS revenue rulings and memorandums that have come out on cost segregation. So there's, again, we have some competition out there that have jumped in maybe 2 years ago that they don't do the full engineering study, and they might sell it on the cheap, but you pay for what you get. And I don't like to see clients being taken advantage of, and not because if the IRS ever came sniffing, that whole study is going to be thrown in the garbage. They're going to disallow all of it. And so therefore, over 15 years, we've had 0 disallowances. So obviously, we're very proud of that because we do it the right way. But however, we've also added property tax mitigation into the mix. So obviously, when you buy a property, if you bought it from the past owner, they've owned it for 20 years, you're going to have a huge uncapping issue, and that property tax is going to go way up. So we can, not all the time, but if we see there's some windows of opportunity that we can appeal and reduce property taxes up. We also have gone into, there's some federal programs for around energy efficiency. One is called 179D, and that therefore you can get up to $1.80 a square foot on your building if you've put energy efficiencies in certain areas like lighting, mechanical, HVAC, building envelope. There's certain qualifiers that kick in, and you can get up to $1.80 a square foot back in the form of a tax incentive. There's also, 45L, which is for renovating and rehabbing and actually new construction for multifamily, senior living around that. Even single family homes can actually qualify, but again, there's some qualifiers on that where you can get $2,000 per unit in a dollar for dollar tax credit for putting energy efficiency into that facility. We have a whole qualifying process and how we can, qualify you and see if you qualify or not. But if you've spent the dollars, most people have never even heard of what I'm talking about. These are just other programs that the IRS has set aside in economic stimulus money that you never have to pay back as long as you implement it correctly. And that's really where we come in.
We're going to need to do like 6 more episodes because just that last credit, I'm like, man, how do I get that? Like I've got, buildings that I'm doing renovations on. Like I'm going to have to sit down with you off the air and figure out if I qualify for any of that. $2,000 a unit can really add up.
Yeah. So, but unfortunately, it's set to expire at the end of this year. So we'll see what happens. It's already been extended a couple other times. So, I'm sure, Biden takes office, very big on green, clean energy. That whole thing will be good for all of us. The other stuff, not so sure about 1031 exchanges. Well, hopefully that'll depreciation. There's certain things that they're talking about, but we'll see. Again, there's a lot of rich Democrats that own a lot of properties, and there's a lot of rich Republicans that love this particular, and it drives the commercial real estate. Don't get me going on this, Jeff.
Listen. Let's
fired up.
Well, we have to wrap up. I mean, we have to
fired up, man.
We got to wrap up in a minute anyway. But Terry, okay. So first of all, like if people want more information about the services you provide, they can go to the website on the screen there, thecostsegguy.com/old-fashioned real estate home. It's old fashioned with an ED, like our show. So old fashioned real estate home. So they can do that. But then you also have this, and you alluded to it, this new affiliate model for people that are potentially, influencers, connected people. It's what Brian and I are doing. I don't want to get too far into the weeds on that, but I will say there's an opportunity for people. If they want to get involved, they should reach out to either myself or Brian, and we'll get them that information. They can do that on Facebook if they're Facebook friends with us, or they can just go to oldfashionedrealestate.com. We have a contact us, section on there. Fill your information in and tell us what you want to learn about. And one of us will give you a call or email you the information that you want, depending on what you're asking. And so we would definitely encourage people that are interested in learning more about CORE to go to the website or to go to oldfashionedrealestate.com and reach out to us. Terry, anything else you want to share with our audience before we wrap up here?
All I can say is just, reach out to Jeff and Brian. And if you have not had a cost seg, you need information, you need some education. They're connected with me. They're connected with my company here, and they will get you information. You'll get the best pricing. We'll hold your hand through the process. I think that's so key. And we're paying, we have a kind of a nice referral model too. So you can actually get your cost segs literally for free based on what we put together. It's a kind of a cool strategy where we're actually partnering with our clients. And so check out that and how all that works. We have different calls up just specifically for that. We are bringing in some of the biggest indicators, some of the biggest names in the industry. Thanks to Jeff and Brian and Travis. So it's been an amazing partnership with you guys. I love you guys. You guys have been great to us. And I just look forward to working with you, into the future.
Yeah, no, and listen, as far as that's
paying taxes, so thank you.
Well, that's exactly right. And
that's the only reason why we're friends, Brian. Come on.
Well, he hasn't even bothered to go see you. Like I've had.
He hasn't called you. He hasn't called me.
He doesn't
I gotta
get
get up to
cookies.
Michigan again.
I don't get cookies. I mean, I don't know.
In fairness, though, Terry, you haven't come down to see us in Chattanooga either, and a lot of our former guests and future guests have done that. So.
Yeah.
I don't know if I've ever.
They're a little more pleasant too, so the timing works out.
Oh, I'm out of here. Just say the word, man. It doesn't even have to be a formal invite. Just give me a wink, wink.
Hey, you know what? Come on down. Get yourself a place to stay, and we'll meet you over at our favorite hangout. We'll have some old fashions, maybe some steak, maybe some lamb chops, something like that. It'll be a good time.
Follow it up with a nice cigar afterwards.
We absolutely will do that for sure, 100%.
See, guys, so if you partner with us on your cost segs, you get to hang out. You get cigars, you get drinks.
That's right.
Steaks. That's how we treat our people. This is the community we're creating. So let's have some fun. We save money. We make money. What's better than that? It's
definitely an amazing opportunity. It's been really great for Brian and I already. Obviously, Terry, it's been great getting to know you these last few years, and I look forward to many more times. And we'll try to get you on the show again in the very near future.
Yeah, we'll talk more about the other stuff that we're doing too. I think it'll be good for your listeners. Definitely some value.
All right.
Thanks, guys. Thanks for having me.
Thank you so much, and you have a great and wonderful day. Brian, is there anything else you want to share with the audience?
Later.
I like it. We old-fashioned real estate out.
You just say later.